Most people in India live on one income, one salary, one business, one source of survival. And when that one source stops, life stops with it. Job lost, business slow, unexpected medical bill. Suddenly, the entire financial system collapses. Not because you are careless, but because you are depending on one pillar. Smart money never depends on one pillar. It builds systems, income streams that run quietly, even when you sleep, even when markets move, even when life becomes uncertain. This is not about becoming rich overnight. This is about financial stability, calm control over money, and designing a life where income flows from multiple directions. In this video, I will show you a simple roadmap, how ordinary people in India can build multiple income streams, step by step, slowly, strategically, without confusion, without unnecessary risk. Let's begin. Disclaimer: this video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Build your primary income first. Multiple income streams do not start with 10 sources. They start with one stable engine: your job, your profession, your core business. This is the fuel that powers everything else. Example: if you earn $30,000 per month, first protect this income. Upskill, improve salary potential, increase earning capacity, because investment power comes from income power. Without strong cash flow, multiple streams cannot grow. Step 2. Start systematic investing. This is where your second income stream begins. Through SIP, Systematic Investment Plan. Simple concept. Every month, you invest a fixed amount. Example, 5,000 rupees per month into a diversified mutual fund. Month after month, year after year. Markets move up, markets move down, but SIP continues quietly. Over time, compounding begins to work. After 10 to 15 years, this investment itself becomes a wealth engine, potentially generating capital gains and future passive income. Consistency matters more than timing. Discipline beats prediction. Step 3. Understand asset allocation. Do not put all money into one asset. Smart investors diversify. Example structure: 50% equity investments through mutual funds or index funds, 30% debt instruments such as PPF, fixed deposits, or debt funds, 20% alternative assets, gold or REIT investments. This balance protects you when equity markets fall. Debt stabilizes your portfolio. When inflation rises, gold provides a hedge. Asset allocation reduces emotional mistakes and improves long-term stability. Step 4. Respect market risk cycles. Markets never move in straight lines. There are bull markets where everything rises, and there are bear markets where fear dominates. Beginners panic during downturns. Experienced investors stay calm because downturns are temporary and accumulation opportunities. When SIP continues during market falls, you buy more units at lower prices, which improves long-term returns. Patience converts volatility into advantage. Step 5. Rebalance your portfolio regularly. Once a year, review asset allocation. Example: if equity grows too much, maybe it becomes 70% of your portfolio, then rebalance. Shift some profit into safer assets, debt or gold. Rebalancing locks gains and maintains risk control. Without rebalancing, your portfolio slowly becomes risky. Discipline protects long-term capital. Step 6. Understand tax awareness. Taxes reduce investment returns, but smart planning helps.
Example: equity investments held more than 1 year are taxed as long-term capital gains, which is usually lower than short-term tax. PPF investments offer tax benefits under Section 80C up to 1.5 lakh deduction, also tax-free maturity. Tax efficiency is an invisible income stream because money saved in taxes is money earned. Step 7. Avoid common mistakes. Do not chase quick profits. Do not follow social media tips blindly. Do not panic sell during corrections, and do not invest borrowed money. Financial stability comes from process, not speculation. Slow systems outperform emotional decisions every single time. Step 8. Scale income streams gradually. Once investments grow, new streams appear naturally. Dividend income, interest income, rental income, digital assets, side businesses. But scaling must remain structured. Do not open 10 streams randomly. Grow them slowly. Strengthen them one by one. Systems first, expansion later.
Step 9. Adopt the long-term mindset. Multiple income streams take time, years, sometimes decades. But the reward is freedom. Freedom from financial stress, freedom from salary dependency, freedom to make life decisions calmly. The secret is simple: consistency, patience, and emotional discipline. Wealth is not built in excitement, it is built in routine. One income pays bills, multiple income streams build freedom. The difference is strategy and patience. If you start today, your future self will thank you, not for chasing money, but for designing financial stability quietly, intelligently, one step at a time.